Welcome back. You're watching Stockwatch with me, Zinati Kuma. Joining me to unpack your stock-related questions tonight are Nader from Benguela Fund Managers and Alex Duys from Umthombo Wealth. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. Although I'm not sure if your questions will actually come through to us because it seems that Microsoft has a problem and at this point cannot access emails, but we'll see what we can do, gents. Alex, I want to start off with you with how the markets traded today, and for me it was quite interesting to see markets holding on to the producer inflation that came out of the US. They handled that in a different way to the US consumer inflation that came out on Tuesday, even though we did see the same trend of those figures coming out slightly higher than what markets had anticipated. Alex, what was so different about this print?
The markets today, look at all share down over 1.2%. Predominantly due to resources, and if you look across the board, gold was quite weak in brand terms. The PGMs actually did okay, the actual underlying commodities, but the share prices did not do well. Financials week, we saw the results from Standard Bank as well. I have a couple other financials did quite well, like the 91. Upside was also up, and I think Old Mutual was also up to some extent. And then a bit of a mixed bag in the property space as well. So a difficult day, and it's been a difficult month. It's results season. I think most of the results in South Africa, I would think it's fair to say it's been fair to below average. So sentiment is not great at the moment, and obviously what's happening globally as well is feeding into South Africa.
And actually, as Alex mentions that the resources were down, but what was quite interesting is the upward trend that we saw in the oil price. Grant, do you think that maybe also added to kind of the downbeat mood that we saw in the markets today pertaining to inflation?
Yeah, it certainly doesn't help when it comes to South Africa. The rand as well gave back nearly 1% on that inflation data because the dollar strengthened for obvious reasons around rate hikes or persistent higher rates. And yes, the OPEC cuts are still in play. There's been attacks on the Russian oil refineries by the Ukraine. There's been a couple of those. So there's a number of reasons, geopolitics, inflation, dollar, you name it. And the oil price has been creeping higher for a while now. It's been a long time since it was below 80 if I look at Brent, and the direction of travel is not positive, and it's probably adding pressure to our inflation outlook, I would say, for sure.
Yeah. Actually, Alex, you mentioned Standard Bank and how it was one of the stocks that were in a red territory today. And quite interesting because, they had double-digit growth in headline earnings, return on equity. And I'm wondering what investors were holding on to there because we saw that share price tumbling more than 6%.
Well, that's actually my stock picks. I guess I'll give my view a bit later on it.
Yeah.
So perhaps I'll give over to Grant for now.
Okay. No, it's fine, Grant. Yes.
You know what? It was a very solid set of numbers, but it was flagged. The market was expecting a good update, so that shouldn't have been a driver for the share price. What was a driver, I think, is the outlook was a lot more somber than the results. And they talked down the outlook, which is understandable. They've got a high base in the trading income. They expect that to be a bit lower. They expect Africa to be great, as it has been, but there's currency risk around that. Interest income in low single digits. So there's a lot of low single digit numbers being thrown around in the growth outlook or mid single digits, and that puts people on the back foot. But having said that, they're still paying a dividend yield over 7%. The operational momentum in the business is very good. They're one of the few that are growing their ROE rather than sort of under pressure on the ROE side. So I don't think, there should be too much surprise. It's had a good run, consolidating on the back of, buy the rumor, sell the fact type of story.
Yeah.
I'm not put out by the market move, and I'm not that surprised.
Yeah. Well, actually, what was quite interesting is that we saw ABSA actually going up, and from what ABSA produced, it was, less growth than what Standard Bank showed today. And I'm wondering, Alex, on your side, what you make of that move?
Yeah, look, I'm actually quite constructive on all the banks, despite probably having a difficult 6 to 12 months ahead of themselves, but I still think they're well positioned. So Absa results, if you look at what's once again a mixed bag. So the corporate side did very well, Africa did okay, and then obviously South Africa they struggled, right? So it's clear that the retail customers in Africa, when it comes to mortgages, personal loans, and so forth, is really under pressure at the moment. And Absa did grow the advances book quite aggressively during COVID, so they took on some extra risk there. And it's now starting to bite them a little bit of credit impairments. But if you add up all the net interest income they've earned over that period, it still offsets the credit impairments, right? So I think they're still relatively well positioned. However, the credit loss ratio is going to be a bit more sticky than I think the market would have liked. And they also do have some issues on Africa, specifically Ghana and so forth. So yes, it was perhaps once again a slightly disappointing result if you think from a short-term perspective, but valuation of apps is still very attractive, and I think if you take a 2-3 view, I'm still quite constructive on it. It's not going to shoot the lights out, but I still think it offers quite decent double-digit returns. And if there does come a risk-on sentiment towards Africa or emerging markets, I think you'll get that extra re-rating as well in the banks.
Grant, do you share the same sentiment that you're bullish on the banking sector overall, or are there, banks that you'd go for, on the upside, or maybe ones that stand out for you on kind of the more downer side?
Yeah, I think, look, we have some picks that we prefer over others, but broadly speaking, the banks are fairly well positioned. You can have a decent total return expectation over the next 12 to 18 months. Your dividend's 7 to 9%, depending on which bank you want to go to. And that's already a start. Then you've got some improving macro with the rates easing a little bit, consumer confidence returning, economic activity picking up. That's assuming that plays out in the second half of the year and into 2025. You're going to see improvements there, and they are cheap. So they're quite a nice place to that offer some defensiveness, but they also give you a bit of gearing to the upside if the macro improves as well. So yeah, we quite like the banks here. Still.
Well, another one that I noticed when it comes to the share price movement was African Rainbow Capital. It surged 10%. And I mean, I looked at the numbers. The first thing that they said was that, it was a challenging macroeconomic environment where that limited the growth in some of its investee companies. And Alex, I'm just wondering, what markets held on to here?
I didn't check the volumes. I'm not too sure how much volumes that go through to, justify the price movement. But in my view, I'm still not necessarily, very excited about the basket of assets they do out there. I think the key was that they guided the time bank is breaking even, and it's going to start going into the J curve. And I think they also mentioned that Rain is going to have about a 2 billion EBITDA. So those are the two key assets, and of course we've got some financial assets in Alexander Forbes and so forth, and then you got a bunch of smaller assets. And well, you can also argue they've got the phosphate asset, which is chowing on cash in a moment, but the remains to be seen if it's actually going to do well going forward. So for me, I still struggle to see what the real purpose of the portfolio is. Seems to be almost like throw a bunch of darts against the board, see what happens and sticks. I would like it to be more streamlined. Perhaps if they focused on, call it 2 to 5 different assets, I think the market would have probably given it a higher rating. And then you've got some of the fee structure issues and so forth in the past, which still probably prevent some institutional investors buying it. But based on today, I think it's those two factors, unless I'm missing something, but I don't see anything specific there that wants me to jump back into the shares.
Yeah, and I was actually talking about a 10% surge. It's actually 13%. That's how it ended the session. Grant, what do you make of ARC? And do you think maybe also a key driver is kind of the future focusedness of the company?
So I want to echo what Alex said about the portfolio. I think that is a real challenge. Remember the NAV, they updated the NAV per share today. It came out at 11 Rand 40. The share's 13% rally took it to around 4 Rand 10 or 4 Rand 20. I don't know where it closed. So it's like a 65% discount. So there's a big disconnect there between this NAV and the actual value of the market is attaching to it. So there either needs to be some serious streamlining of those assets or some cleanup or something to unlock that value. Otherwise, it's one of the deepest value traps that I've ever seen. And it's always been at a discount to NAV, and the NAV discount is actually getting bigger over time, even as their star assets are starting to perform. So I do have to ask the question, Time Bank is only 20% of the NAV. If you want to access Time Bank, it's a pretty poor entry point. Rain is 27% of the NAV, so that's a decent amount, but it's still less than 50 if you put those two star assets together. So you've got to then look and sift through all the other stuff, the crops, the agri sort of portfolio. It's a lot of noise in there, and I think investors are skeptical. We need some clarity. We need to see what are we actually buying, or how do we buy what we want to buy, and how do we avoid the rest of the stuff that's in there. So they've still got some challenges, and I don't think they seem to be in any rush to do what investors are actually asking them to do. We've been asking them for years to clean up the portfolio and just crystallize some of those assets into and more focused. But until then, I don't see much significant change here.
Ah, all right. Well, a share price that I didn't expect to perform the way that it did is Exxaro. That also sank about more than 3%. And Alex, this is even when the company declared a special dividend. Yeah, what did you make of that reaction to those numbers?
Look, the results were broadly in line with estimates, so I think that was decent, and they're certainly surprised with the special dividend. So I think it should have been seen on a net positive. So I was also a bit surprised as a pullback, but we did see resources being quite weak on the day, so I won't read too much into it. But I think in general, Exxaro is still relatively okay position. I think investors are still concerned about capital allocation risks. So yes, they did pay special dividend, which reduced a little bit of that, but they do want to spend a lot of money on renewable energy projects, which does raise some concerns from investors. And then, of course, highly exposed as well to iron ore, which, it's been holding up, but, if that doesn't do well, you pretty much, that's the one of the key cash cows. And then, of course, we've got the coal assets on top of it. So, I think buying Exxaro at the right time probably is a good business. At the moment, I'm probably neutral towards the business. But if they continue to give money back to shareholders, it can certainly change sentiment more in their favor.
Grant, what do you make of the diversification of Exxaro at this point?
Yeah, I think it's such a difficult one. I mean, they're generating a lot of cash. They've got 15 billion pre this dividend, which is 5.7 odd billion. And so if it's a company's stated intention to invest for diversification and growth, it comes with a lot of risk about how poorly or how well they allocate that capital. And so while I think long term this company needs to ultimately diversify, we all know the challenges facing coal longer term, and there's other considerations around that. They also need to do it in a way that makes sense to shareholders. Otherwise, rather just give the money back to shareholders. So that's actually probably the risk in this company rather than the opportunity, unless you start to see some really smart deals being done there with that cash.
But just some of the news that have come out during the week, Grant. We Buy Cars now. A date has been set for the unbundling and the separate listing of We Buy Cars. What's your appetite on that?
We're an interested bystander at this point in time. I think it looks interesting. Want to see where the price clears. Want to look at take some time to go through the numbers. We're not going to rush in, but I think it is nice to have a new listing on the JSE. Something that actually looks quite interesting as well. We haven't seen much of this in the last few years, so I'm excited to watch it. We're not rushing into the company at this stage. We're still going to do a bit of work on it. That's my short answer.
All right. On your side, Alex, and also maybe you can bring in now, what you make of what's going to be left of transaction capital after this listing.
So I echo what Grant said there. We're exactly also on the sidelines. I think a bit skeptical to get involved in IPOs because most likely you're going to overpay for the asset. And you do want to get a sense of where the valuation is going to sit and also get a better understanding of the business model through a cycle and so on. What's the real rating of the business? It's difficult to say at this particular moment, and I think it's perhaps just better to wait and see, because there will be a time in the future to buy it at the right price.
We'll talk.
The rest of transaction capital, I'm not constructive on.
Okay.
I mean, SA Taxi, in my view, does have a negative value. If you can't put zero, you have to put negative value in that business. And then, I guess the credit business, it's got decent value, but you need capital to run that business, So obviously, they got some problems there. I'm not constructive on that business. I think, if you look at earnings quality of transaction capital, in our view, has always been weak balance sheet. Reputation has been destroyed. I'm not too sure investors are going to get jump back in transaction capital post the unbundling of WeBuy Cars.
Well, I mean, talking about IPOs, what about Boxer? Would you say would you have the same sentiment that it's a wait and see game at this point as well, Grant, or not?
I must say, Boxer actually sounds a lot more attractive to me. I think it's a good asset. I mean, if the last numbers are to be believed, it's growing at a faster clip than Shoprite. So I think it looks like it's a good business with a decent runway for growth. And I would definitely have a closer look at it and find it quite interesting as an opportunity.
Yeah, all right. So Grant, more upbeat about Boxer than we buy cars. On your side, Alex, would you be plowing into Boxer when it does eventually list or not? Or maybe you're finding more value on Pick n Pay at this point?
So once again, it'll come down to the valuation on Boxer and how much shared cost is currently in Pick n Pay that gets to the benefit of Boxer and that they might not have going forward when they go independent, right? So that might have impact on the margins and profitability. So we'll have to wait for the actual facts before you can really put a valuation on Boxer. So whenever they do come to the market with the full detailed results and the potential IPO, I think we'll get much better sense. But certainly there does have a huge growth profile, but you still need to pay the right price for them and understand the risks in the business. Pick n Pay is impossible to say at the moment. So I would like to say yes, but you can't say so because we don't know what the extent of damage is in the corporate stores and Pick n Pay. How much money are they bleeding there? How much money do they need, for example, just to close the stores, let alone fix it, because some of the leases you still need to pay off. And at the same time, you're fighting against a competitor in Shoprite, which is just spending money and saving it, also investing into price, meaning it makes it cheaper for a customer, which makes it very, very difficult competitive environment. I do rate Sean Summers. I mean, he was real competition for Shoprite back in the day, but he's got his hands full here, and let's see what happens. I won't jump the gun yet. Let's wait for the facts before we get too excited or too negative on Pick n Pay.
Yeah, all right. Well, sticking with food, Woolworths Food is changing its CEO. And of course, under the Woolworths stable, that is really the bright spot. Grant, what do you make of, Woolworths at this point and just looking at that whole portfolio and if maybe we could, still have more runway on Woolworths or if it just depends on the foods division?
Woolworths is a really, really interesting one. Food remains a star. I think the succession change is solid. They've had plans in place. He's been there a long time. So I think that's all good. It's the FBH, the fashion, beauty and home, where we still have some question marks. And we really, have to dig a little deeper there. I thought the trend was reversing over the past couple of results updates, but the most recent one was very disappointing. It might be a function of the environment, but there might be something a little more going astray again in the strategy. They've struggled in the past with that. They've lost touch with their user base, with and the margins came under pressure, the volumes came under pressure. So I have some question marks there. I still think they've got enough of a core good business. I don't think there's any reason to get too concerned, but I do think that you need to pay you need to look at, are you paying the right price and what are the challenges in that FBH, which is still a meaningful part of the business.
Yeah, you're actually right. It did look like it was making a meaningful turnaround at some point, but of course the last few updates have not been so good, particularly with the port challenges that we are having. Alex, what do you make of Woolworths and also just the composition of that business?
I think, first of all, in the food business, I'm not too concerned when it's management change because a business like Woolworths, I would imagine there is very strong senior and middle management in that business that runs the business. Not only a one-man show, but runs it. So, yeah, I think the change, as Grant said, has been well planned for. So I would imagine that business will continue to do well. FBH did disappoint. I mean, Mani Maritz was brought in with high good reputation, and he did initially quite well, as Grant alluded to. I have to think that there must be some issues with the economic efficiency because at least they still held the GP margins, which is quite important, something they're trying to do there. But we're seeing an overall results on the banks, the consumer in SA is under tremendous pressure. And it's going to take some time to work through the system at the moment. So, can they work? Can they continue to innovate by, making the stores, perhaps high densities, get some of those old customers back, perhaps get new customers in, remains to be seen. but hopefully this was only a blip and not a new trend that's emerging there. And on Woolworths itself, I'm a bit concerned about their capex profile going forward. And they want to do share buybacks. I think the balance sheet might be a bit under pressure if they do so. Also, because the cash generation is not as good as they claim it is, in my view. So they might have to sell that property in Australia, I think, to fund it. So, which makes sense to me. But to do that, then yes, Woolworths could be interesting, but it's been moving parts.
Yeah.
It's not an easy business to necessarily value and get the risk right on it.
Yeah. Well, talking about businesses that are not easy, I want to go back to resources. Of course, today declining more than 2.5%, that resources 10 complex. Grant, of course, there's been a lot of volatility here where markets have been trying to find the bottom for these stocks, and it seems that they're just not finding it. Would you take this as a buying opportunity or just a signal of more risk to come on that front?
On resources, look, yeah, I think you're quite right. Bottoming is a process. It's not something that switches on off overnight. Yesterday was the bottom and now we're going up today. So you have to accept that as an investor. You have to just acknowledge, are things at least stabilizing, and what are the fundamentals that are supportive of the view. I think personally that it is time that you can start dipping your toe in the water. You can start nibbling. You will never get the timing right. So don't even try. Just rather establish what kind of position you want to have over a period of time when the right numbers stack up for you, and start buying gradually. Just phase your investment in and just keep a close eye on if there's any sort of outlying risk factors given the volatility that commodities has. So yeah, I think it's starting to look a lot more interesting here than it has in quite a while.
Alex, are those resources valuations too good to pass up at this point?
Look, I mean, any business or business cycle goes through extreme peaks and troughs. Has got an emotional pendulum. It also goes from euphoria to extreme pessimism. So, things can get a hell of a lot worse than you think it can in these stocks. And Grant, 100% right. The time it's almost impossible. So I like to rather look into resource space and say, ask myself first, do I want to have exposure? And if the answer is yes, then ask yourself, okay, then you played it more relative to each other. I mean, which stocks are looking more relatively more attractive? Are the balance sheets stable? Are managing good? Do they have good capital allocation records? And then it's about pretty much wait and see for evidence. And when you start seeing evidence going in your favor, then you can perhaps increase conviction. For example, a moment, and I haven't held Anglo-American for probably 3 or so years, but I'm starting to pick it up now.
Okay.
I might be way too early, but I'm looking at Anglo-American, for example, relative to Bulletin. And say, okay, that's an opportunity. But it's very, very difficult to time these businesses. And yeah, wet your toes and increase conviction when you do have more confidence.
All right. Well, gents, let's get to your stock picks for today. Coming to you, Grant, what are you picking?
I'm just chuckling because my stock pick is Anglo-American today.
Nice segue. Okay, nice.
Let's jump the gun there. Yeah, I think it is looking interesting here, and I'll tell you why. I think Anglo's looks interesting, particularly because Billiton is the higher quality operator and it's lower risk. Anglo's has got a much higher risk profile because it's the PGMs, the platinum and the diamonds, which have been under significant pressure. But if you take them as a percentage of earnings now, they're well below 20%. If you add the two together, it's maybe 15-16% of Anglo's earnings. So the risk to earnings is significantly reduced. You've got the prospects for iron ore and copper still embedded in Anglo's. And then you've got the optionality should platinum kick up from here or diamonds start to recover. We are seeing signs of a recovery there as well. So I think Anglo's looks interesting at these levels. I would start buying. I'm not saying now's the moment and go all in, but I would start buying here, and I think it looks interesting.
All right. Alex, we do know your stock pick for today, Standard Bank. The floor is yours.
Yes, I think, as Grant alluded to, the results was very good, but well guided for, and perhaps the guidance was a bit disappointing. But if you take a 2 to 3 year view, I still think that Standard Bank are well positioned. First of all, their balance sheet is very strong. If you look at the capital adequacy ratio, the provisioning is also quite high. So they will have a lot of room for any potential surprises. If it doesn't happen, you can unwind those provisionings as well, which will boost earnings growth rates. They can also increase dividend cover even further if they want to. So I think there's a lot of options on the pool, and they do have some actual growth potential. Despite the dismal economic conditions in South Africa, they've been growing quite well over a few years. Strong franchises, good management. I think if you are willing to wait a little bit, you will make a decent return, especially perhaps in the second half of this year or first half of next year when interest rates do start coming down and perhaps risk on sentiment towards emerging markets start getting better. And of course, the elections in SA also something in the past. I think that will help a little bit because you do need foreigners to buy our companies, specifically the banks, because it tends to be quite a consensus buy from a professional investors at the moment, which concerns me a little bit. But I do think that when the foreigners do come back in, that will give that extra layer of growth ahead for the banks.
All right. Well, thank you so much, gents, for your time and for your analysis today. Really appreciated. That is all for tonight's Stock Watch. Thanks to our guest, Nader from Benguela Global Fund Managers and Alex Duys from Umthombo Wealth. Up next, the close. Stay with us.